Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I've had him on a number of times in the past. I've followed his work for years. Very impressive work. He writes one of the top economics blogs in the world in terms of traffic. His articles are on Zero Hedge all the time. His Twitter is very interesting, and he has Mish Talk. Mish Shedlock, thank you for joining me again.
Pleasure to be back on the show, Jason.
Now, Mish, we're almost done with the year, only a couple months left. But what do you think are some of the most important things that people should be paying attention to for the rest of 2018?
Right now, we've got an emerging market crisis here in debt. It's hit Turkey extremely badly. Trump has just gone a tariff rampage. I think that is going to backfire on him brutally. There's a number of U.S. senators that are upset with his tariff policy. I'm a big free trade advocate, and I don't believe that the way to get free trade is by going into a trade war and putting tariffs on everyone. Gold has been hammered as the dollar has strengthened. That's a function of, a lot of belief in the Fed that they're going to keep tightening. I think they're going to keep tightening until they break something. That's what they always do. How long all of that takes to play out is going to be the determining factor here when gold decides to lift off. Certainly shorts are building in gold. It wouldn't surprise me actually for the specs to be net negative on gold in the numbers that come out tomorrow for Tuesday. Those are the three things here: the currencies, the euro, emerging markets, trade policy, and what to do about gold.
So we're recording this on Thursday, August 16th, 2018. The dollar index that I'm looking at right now is 96.6 for our listeners out there who want the date and the dollar index. So the dollar index has had a big rally since March from around 88 up to here. The dollar rally will probably continue in the near term, but I agree with you. I think at some point it is going to do some really bad damage. We're already starting to see some emerging markets out on the periphery. So it's kind of like, with the housing market, how first the housing crisis started in subprime and then it kind of filtered into the rest of the housing market. So we may see that at some point because the counterparties that these European banks have, a lot of these European banks have a lot of exposure to a lot of these emerging markets.
Yeah, these emerging markets borrowed money in dollars and now their currencies are sinking. They're in serious trouble. The other key aspect of the macro picture, which I should have mentioned but didn't, has to do with a lot of corporate borrowing. They've been borrowing money like mad to buy back shares of stock. At some point, that's going to matter. I did a post on this the other day showing junk bond divergences with the market. We saw these same kind of divergences in 2007. We've seen them before. If the junk bond market stays healthy, I think equities will stay healthy. Right now, the junk bond market doesn't look healthy, and if that continues, I think we're going to see a substantial sell-off in the stock market. And of course, it's the stock market that's been buoying up retail spending here. Consumers have gone on a spending spree, except on housing-related stuff. Another weak housing report today. Economists expected starts to rise. Well, they did, only from a downward revision. Economists missed the mark by almost 9% versus their expectation. Some people think that housing is going to recover. I think it's more likely that housing is going to lead the weakness down.
And the home building stocks have looked like they've been in a bear market for a while. But if I could add to your points there, like the U.S. government has claimed to have record tax revenues, but a lot of their tax revenue increases have been on capital gains taxes on stock, on winning stock trades. So it seems like that's Go ahead.
What I was going to say is the Trump tax cuts were extremely front-loaded, mostly this year and next. And after that, they're going to slowly actually be hiking taxes. So I don't see that this strength has legs to it, and the same applies to earnings. There's going to be a mean reversion here in earnings, and when that happens, we're likely to have a bloodbath in equities. But everyone is guessing when that's going to be. I certainly never thought we'd get this far. The bubble would get this big. John Hussman's been talking about that. So has GMO, which is now predicting something like 5% declines on average for the next 7 years. So both of them were right last time. It's just taking them a lot longer here this time, and I think we are going to see those negative returns. It is going to destroy pensions.
Well, Mish, I think I just saw your article on the pension fund crisis that's coming up and how there's huge blowouts in that. But I think the people in power, the economic and political elites, the people running the central banks and governments in the key economies, they've changed the rules. I remember, I think 8 or 9 years ago, you did a really good inflation versus deflation debate with Peter Schiff on Financial Sense. And basically, because of all this intervention with the central banks, they basically made both of you look somewhat wrong, because nothing that anyone with any rational economic sense thought would happen has happened. There's been monetary inflation, but almost all the monetary inflation, or a large chunk of it, for the last 10 years since the 2008 financial crisis and the bailouts and QE started, it's gone into asset prices. And
that's exactly correct. And another asset bubble bust is coming, and with it, another round of deflation. Very few people are calling for that. I think I essentially got the picture right, except for the fact I did not think the bubble would get as big as it did. Those people calling for extreme inflation, and there's still a number of them. In fact, almost everyone is still calling for this inflationary boom. We've had it. We've already had the inflationary boom. It's in assets. It's in bond prices. It's in stocks. It's in borrowing. It's in corporate borrowing. It's everywhere one can look. It doesn't show up very much in the CPI. We're like 2% inflation or something. This is the same mistake the Fed made in 2004, 2005, 2006. They do not consider home prices as part of their inflation model. If you do, inflation is way higher and way behind the curve, and just these baby hikes that they've taken, and they've gotten more in than I thought they would, are starting to hurt the housing market. Not already people were unable to, could not afford to buy houses. The rise in interest rates makes home prices even more unaffordable. That's the position we're at here. So I don't get where people expect another big surge in home buying to come from, for the simple reason I question who doesn't have a house that wants one and can afford one. That's the we're at.
Unless, Mish, it's a bunch of flight capital, people from Europe or China coming in here, maybe because of a larger RMB devaluation coming. And we've already had a lot of purchases from people outside the United States coming in here and buying up real estate. The same thing in Toronto and Vancouver, Australia, London, etc. But, maybe if China does do a massive RMB devaluation, maybe that spooks more Chinese people with savings to get currency out of the country any way possible, and you get one last blow off top then in some of these asset prices. Also for 2018, Mish, we have quantitative tightening, which is supposed to ramp up in a little under 2 months now, about 6 weeks. So the Federal Reserve has already sold off, according to their publicly stated balance sheet, about $250 billion in assets. Trump wants to run really large budget deficits. You talked about the Trump tax cuts, Mish. That seems to me like it wasn't real government. It wasn't a real tax cut. It was only like supply side economics because the deficit's growing still. There wasn't a corresponding cut in government spending. So do you think in the long term that this is going to be like maybe stagflationary? This is going to cause problems with the dollar? What's your views on this?
I've never been a big proponent of another huge stagflationary bust like we had in the 70s. It's the debt stupid. I don't think we're going to get there again. The question is what happens to asset prices when the Fed reverses course here and no longer is on this tightening path. And I don't know. And again, we're all guessing here on that. But let's just talk about gold here for a second. Gold tends to do well when there's faith in central banks that they have everything under control. If we go back to Mario Draghi's statement a few years ago, gold topped over 1900. The euro was in crisis. Mario Draghi comes out and he says, we will do whatever it takes to save the euro, and believe me, it will be enough. That was his statement. What did the ECB do? Nothing. The ECB at that time, for another 2 years, the U.S. had started quantitative easing. Europe hadn't yet. What did the ECB do? Nothing. They made that statement. Faith in the ECB that they had everything under control was restored just by talking. Gold peaked shortly before that and then sank all the way to 2014, 2015. Around 1,000, and we've seen gold come up off of that. What's happened? People are again starting to question whether or not central banks have things under control. Gold has taken a hit in 2018. Again, the same situation. Not so much the ECB this time, but the U.S. this time. Well, the Fed now has everything under control. They're going to keep tightening, blah, blah, blah. Stocks are good. It's this kind of environment that's very bad for gold. But, I mean, look at where gold has come from. In 2000, it was all the way down to 250. We're at 1,200 roughly now, a little bit under that right as a result of the past few days. But that's a pretty big rally. And I think another big one is coming, and the catalyst is going to be that the Fed does something surprising, and that surprising thing, I can already tell you what it is. They're either going to give up on their quantitative tightening, or they're actually going to get to a point where they're going to be cutting rates sooner than expected because the economy stops growing. That's, the picture that I foresee, and accompanying that is going to be another round of debt deflation, possibly this time in corporate borrowing, where they've borrowed all of this money and plunged it into the stock market. What happens when they have to pay it back? The consumers go away and their stock prices are plunging. It's not a very good setup, but that's what I see happening.
And the narrative I think that hedge funds are trading on right now is because the dollar is strong against emerging markets, and also on the dollar index that they should be short gold. So they're long dollar, short gold, maybe short other things along those lines. But I agree with you. I think at some point the Fed's going to realize that they can't raise rates anymore, that things are going to break in a credit market or with an emerging market. There's going to be emerging market foreign central banks from emerging markets or bankers from emerging markets telling them that they can't, raise the dollar. Also, I think, Mish, correct me if you disagree with this, but I think President Trump and his Treasury Secretary Steve Mnuchin don't want a strong dollar. Do you think at some point that they'll step in and do some type of intervention to prevent the dollar from strengthening anymore?
They have only done that in extremely minor ways historically, a couple of times, very small. It's certainly something that Japan and China do all the time. In the trade war here with China, the Chinese exports have not declined all that much, and one of the reasons is China has manipulated the yuan lower. This is why all this talk about China replacing the U.S. as the global reserve currency. I mean, Peter Schiff and other people are on this bandwagon. It's complete nonsense. To have the world's reserve currency, you need a large functioning bond market. China has none, next to none. The U.S. has the largest, most liquid bonds in the entire world. China doesn't even float the yuan. So all of this kind of talk is absolutely crazy. China has no property rights per se, like we do in the U.S. These are the reasons why the U.S. has the global currency. So let's just put that idea that China is going to replace the U.S. to bed. But, you know, if Trump increases sanctions on China, China is going to, most likely, going to let the yuan sink lower. The risk for China is capital flights. So far, it hasn't happened this time. And by the way, when you have to put capital controls on your currency to prevent it from leaving, you know, that's another sign that you're not ready for to have the world's global reserve currency. So what would Trump do in response to that? I would expect he would charge China with being a currency manipulator. He's hinted at that already. All of these little things, these trade disputes, you know, these threats and counter threats with the EU. He's in danger of wrecking the auto market because of steel tariffs. All of these things add up. One does not know which is going to be the straw that's going to just collapse the camel, but one of these is, and we're pretty much guessing again at what Trump will do, other than continue what he's been doing, attempt to, you know, bully China, the EU, whoever, Canada, Mexico, into doing what he wants. But so far, this agreement with Europe doesn't amount to a hill of beans. And so, you know, we'll see. I think there's a strong chance that if he continues his trade path, that the Republicans lose at least the House in November. And it's not out of the question that they would lose the Senate in November as well, depending on how severe the backlash is over these tariffs. These are the kinds of things, you know, that I've been looking at and watching, and they're all stacking up like a giant game of Jenga where you're pulling one piece and you're waiting for the whole thing to collapse. So far, it's still holding together.
Yeah, I was going to ask you about the congressional midterms. You know, if you're right and the Democrats do win the House, they will bring impeachment charges, but if the Republicans still control the Senate, it won't go anywhere. But that will cause...
Well, it won't go anywhere, even if they win the House and the Senate. It takes two-thirds majority to convict him. Not going to happen. There's even going to be some Democrat senators that would not vote for that. So the whole thing is a total waste of time. I don't even think, you know, the House would bring that, even if the Democrats do manage to win it. That's a sideshow. You know, whether or not that would disrupt the markets, I don't know. Possibly for a week or something. But everyone understands it's not going anywhere. It's a big waste of time. It'll just be a political stunt.
And it would cause, if the Democrats do win the House, it'll still cause a lot of extra gridlock. So as tough as it is for Trump to get anything of his agenda passed now, even with a slight majority in Congress, it's being touted by the regular mainstream media that the Republicans have a majority, they should be able to get what they want done. It's just not true. It's very tough for them to get anything done or pass through because of the Democrats are like not helping them really with anything. But if there is Democrat control of the House, the gridlock would just be even worse at this point.
Absolutely. Already, there's a couple of rogue, I don't know if I'd call rogue is the right word. It's Republican senators that don't want to, go along with him on some of this stuff, especially trade. The Republicans actually introduced a bill in the Senate to curtail Trump's ability to use national security as a trade measure unless he gets Senate control. Now, of course, he would never sign such a bill, but that's how far we've gotten here with open defiance of Trump on trade. There's a lot of senators and congressmen who are just really upset over Trump on trade, and I believe they're right. What Trump is doing is going to backfire. The question is whether or not it's going to backfire soon enough to cost them the House.
Well, the funny thing, Mish, I've lived right outside Washington, D.C. for since the year 2000, and a lot of I hear scuttlebutt around here. I do have some contacts in the political sphere, and a lot of the Republicans in Congress, a lot of them actually hate Trump, but they won't speak out publicly against him because he's very popular with his base. So there's a lot of the Republican Party that's switching over to Trump, and a lot of the regular Republicans don't like that. The rhinos, they don't like that stuff. The neocons, they don't like that stuff for a lot of their policies. So, they wouldn't. Let me just put it this way. I don't think they'd be upset if Trump only lasted one term.
I don't think he's going to last more than one term, but we've got another 2 years to go here, and again, that's going to depend on whether or not the country's in recession or coming out of recession. At the time, from that regard, he would be better to have a recession now, get it over with, and have the economy recovering at the time of the next election, rather than going through what happened in 2008. Before Obama even won the nomination, I predicted 49 out of 50 states accurately. I had friends tell me, Mish, you are absolutely crazy. There's no way Democrats are going to carry some of these states. I said, just watch what this recession does. And so Republicans, better hope that they don't head into an election with a recession underway. They're going to get killed.
Well, there's an ideological, sorry to interrupt you, Mish, but there's an ideological problem that's growing rapidly in the United States, too, now. If you look at the polling that's coming up, people in my generation, I'm Generation X at the beginning of the millennials, that type of generation, or younger, they prefer socialism. So, they're going to vote their ideology, and they're going to be the ones in power in the near future.
Actually, I think that had Bernie Sanders won the nomination, he probably would have won the election. The independents and especially the millennials sat this thing out. They did not want Hillary in there, and a lot of people voted for Trump as the lesser of two evils. I voted for Trump, and my big rationale, because I didn't like either of them, was simply I thought Hillary was a bigger warmonger than Trump. I would prefer a libertarian candidate. We didn't have anybody that came, close that had a chance to win.
Agreed. Gary Johnson was a total joke, and there was huge corruption within his campaign. I think his campaign manager came out was actually getting grossly overpaid. Do you think the country, you've been around more than me, do you think this country is headed towards like polar extremes now? That is there this in the past? Was there this many radicals on either side, or do you think that this has grown to like an exponential level?
Well, it's about different things. If you look back to when I was in high school, I was vehemently anti-war then, very much against the war in Vietnam, which was raging. Now, because we don't have a draft, it's about other things. When I went to college, believe it or not, tuition at the University of Illinois for a degree in engineering was $250 a semester. I financed myself through college playing poker. Try doing that today with a $20,000 bill by against farmers in Cayuga, Indiana, or wherever, and you're not going to come up with even come close to your tuition. You'll be lucky to win enough to cover your books. So a completely different environment. The issues are different. The kids are mad, and they're mad rightfully because they've overpaid for their education versus whatever salary they can get coming out looking for a job. So are they any angrier than we were? I'm not sure. They might even be less angry than we are, but they're angry over different things, and this time it's money instead of war.
And they're blaming capitalism, although I don't think that's fair. There's competition in the global economy. China was able to get a lot of those jobs. There was, they talk about free trade. I mean, there hasn't really been free trade for a long time. The U.S. didn't have tariffs on a lot of other countries' goods, but a lot of other countries have tariffs on importing U.S. goods. So that to me, in my opinion.
I mean, the U.S. is not to blame here. Excuse me, the U.S. is not faultless here. The U.S. is to blame, is what I meant to say. Look at our tariffs on sugar, on ethanol. Those products are best produced somewhere else. Brazil comes to mind, for example, for both of them. Instead, we've got, literally inane policies here to protect the sugar lobby, the corn lobby, the ethanol lobby, and then, we rail at Canada for lumber. Excuse me for pointing out, but if Canada wants to subsidize U.S. lumber, that's actually good for the U.S. housing industry. And the same thing, if China is really giving us steel below cost, we would be crazy not to take it. We have millions of manufacturing jobs that use steel, aluminum, commodities as imports, and we're willing to risk all of that to protect a few 100,000 steel jobs. It's crazy, but that's what we've done. So, there's never been free trade, anywhere, and the first country that does it, no matter what any other country does, is going to flourish. I think you might find that in Singapore perhaps, but there's no major country, global power, that's ever just stood back and said, you know what, regardless of what anybody does, I'm going to remove tariffs. If the U.S. did that, the economy would take off, guaranteed.
Now, I want to ask you about China since you touched on it earlier in the interview. Do you think that there's a credit bubble in China?
There's a credit bubble almost everywhere. The question is, where is it worse? There's a credit bubble in Italy. There's a credit bubble in China. In China's with the state-owned enterprises. In the U.S., it's back again with housing. Not as bad as it was in 2006, but in the U.S., it's in the corporate and junk bond and leveraged bond markets. In Italy, Spain, it's with banks that are insolvent. These loans that they've made over the years can never be paid back. So yeah, there is a credit bubble everywhere. Italy and Spain owe Germany close to €1 trillion. How are they supposed to pay this back? Well, let me tell you, they're not. So it's manifested itself in different ways in different places. In Japan, it's Japanese debt. The corporations in Japan have not borrowed at all. There's no debt bubble there, except what the government has done trying to get Japan out of deflation. The answer is for the central banks to just stand back, do nothing, but they can't. They won't. They won't do it. They think they know what they're doing. They prove time and time again that all they're good at is blowing bubbles.
So you think that the economic and political elites won't allow real deflation for more than maybe 6 to 12 months, like what we had in 2008, how they briefly allowed Lehman Brothers and some other things to fail, and then they stepped in. And, maybe they do allow a stock market crash, but it's only for a short period of time before the next QE program?
Well, pretty much. But, one has to look. If central banks could actually prevent deflation for a long time and prevent market crashes, then someone has to say, well, what happened in Japan? Why did they have 2 going on 3 lost decades? Why did the Japanese stock market go from 40,000 to 8,000 over the course of 15 or 20 years? So I'm not predicting that scenario here for the United States. I'm merely pointing out that such a scenario in the U.S. is possible. So my prediction for the U.S. almost 10 years ago was that the U.S. would go in and out of deflation over the course of the next couple decades several times. Not gone back in there yet, but I think it's coming, and all it's going to take is another asset bubble bust, which is deflation by definition. Of course, my definition is a little bit different than a lot of people's, so let's define it. Inflation is an increase in money supply and credit with credit mark to market, and deflation is the opposite, a decrease in money supply and credit with credit mark to market. And the mark to market is important because when banks are capital impaired, they won't make loans, credit dries up, and things start falling apart. This is the aspect that all of the inflationists missed before. They're missing it again right now. They don't understand that these debt bubbles, these unstable debt bubbles, are inherently deflationary by definition when they pop. That's what they're missing. They missed it before. They're missing it again. What the Fed does next time is going to be quite interesting because I don't believe that they're going to have their balance sheet unwound by the time the next crisis starts.
And Mish, there's certain people out there, I would call them China defenders or China permeables, and they've been telling me that I'm wrong about China, that there is no credit bubble there, and even if there is, China will just deal with it easier because internal debt is better and easier to deal with. So what's your opinion then on this internal debt then, and if it's easier to deal with for a government?
If it was so easy to deal with and so easy to fix, then explain Japan. If it was so easy to deal with and so easy to fix, explain Italy. So this idea that it's so easy to fix has already been proven wrong.
Agreed. I think best case scenario for China is what happened to Japan maybe 30 or 40 years ago. So they don't totally collapse or anything like that, but they do kind of slug around. And remember, people were saying that Japan was going to take over the world. It didn't really happen, although Japan has some really strong companies, but they didn't take over the world, and we're not all speaking Japanese.
And we're hearing the same thing again. The Actually, two ways. Some people still believe that China is going to take over the world. Bunch of nonsense, if you ask me. I explained all the reasons. They don't float the yuan. They don't have a bond market to speak of. They have to resort to capital controls. They don't have economic freedoms. They don't have freedom of press. And they don't have property rights. So, excuse me, but wake me up when China has all of those things. And, then, we can start talking about whether or not China is going to rule the world.
And they're also implementing this social credit score stuff, and it's ramping up with more technology. They're having citizens report on each other. I mean, this is Big Brother 1984 Orwellian totalitarian government stuff. Not that the U.S. isn't doing something similar with what the social media companies and big tech companies are, but I don't know if the U.S. government is fully supporting all the stuff that the big tech companies are doing right now.
Well, I mean, that's another one. And I've got to run after this comment. But, if you look at the, freedoms here in the United States, we've got a lot of problems. We've got warmongers. We waste a lot of money on offense, not defense. We've been in Afghanistan for 17 years. Amazing here. We've wasted trillions and trillions of dollars that would have been better spent here in the United States. But aside from that fact, the U.S. has the largest, freest, most liquid credit markets in the entire world. And if you look at the EU, they want to try and bust up Google. They want to bust up Amazon. They want to bust up Microsoft. They want to bust up all the U.S. Corporations that have actually been extremely successful. Look at all the jobs that Google creates. It started out as an internet search engine. It's now into electric cars, self-driving cars, vehicles, all kinds of communication aspects. The EU would take Google and destroy it. So these companies exist in the United States for a reason. They don't exist in China. They don't exist in Japan. They don't exist in the EU for a reason. And that is one of the things that makes the U.S. great to despite what all of the other U.S. bashers want to say. That's why China is not going to replace the U.S. anytime soon. It's why the EU can't get its act together, because they're busy meddling in everything. If a company is too successful, they want to bust the damn thing up. Absolutely crazy. So, that's what's going on here. But we still have this global credit bubble. It's going to pop. I don't know where it hits first, whether it's China, the U.S. corporate market, Japan, the EU, perhaps Italy leaves the EU. All of these things are possible. I don't think it starts here in the U.S. It's going to start somewhere else, but the ramifications are going to be global. China, unlike what Peter Schiff and others said in 2007, did not decouple from the global economy. The U.S. is not going to decouple from the global economy now, in 2018. I got to go, Jason.
Well, I want to thank you for your time, Mish, and if our listeners want to follow your work, how do they do so?
I'm at themoneymaven.io/MishTalk, or you can just do a Google search for Mish Talk, and you'll probably find me.
Great. Well, thank you for your time, and keep up the good work.
Thanks, Jason. We'll see ya.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website, and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.